if you can see the screen, and I think then we are ready to roll forward. We did anyways cover a lot of content from this topic in our last discussion, and I think there was something residual pending, which was about earnings per share or EPS, right? So today's discussion would obviously first be centered around our EPS related calculations, and then from EPS, I think we will move towards the topics for the day that we would like to cover. Let's just roll it all the way to where we paused in our last discussion. Research and development cost, we did expense. Yes. So we will move towards expense recognition, and we'll start our discussion today from expense recognition category largely. So in expense recognition, and again, sorry, yeah. From an expense recognition perspective, like we had a revenue recognition concept, we had a concept around where we said, apart from revenue recognition, there is expense recognition that we have to look into. Now, recognizing expense in itself involves making certain estimates, right? You cannot obviously have an expense recognition, completely, which is accurate, but you will have to forecast in terms of what your expenses may look like, or is there a possibility of having a loss in certain accounts. So for example, the first one is a doubtful accounts, right? So when we say a doubtful account, we are largely focusing on money that we have to collect. And is there a possibility that we are going to lose some of the money that we are going to collect? Now, if that is the case, we are saying that there is a possibility that there is a loss of funds or loss of money from our perspective. And in that case, we have to ensure that the expense associated to bad debt, right? This is called as typically expense associated with bad debt. So when we say expense associated with bad debt, we are largely focusing on recording expenses where we believe that I will have to record a bit of loss, right? That's typically a small amount of loss where I will not be able to collect the money from my customers. And therefore, the firms will recognize expenses in the period of sale rather than a later period when it actually occurs, right? So this typically becomes an expense that you recognize, but you recognize it in the same period. You do not wait when it actually occurs. So if you have sold $100 of product this year, and if you think $10 of product or money will not come back to you, right? That is something that the customer may not pay or default. Then record that $10 as part of your expense in the current period itself. Do not wait for it to actually happen, right? It's based on accrual accounting. So accrual accounting says be conservative in your accounting, record all your losses upfront, okay? And do not wait for the time period when it actually occurs, right? So just be conservative and do all your or expenses upfront recognition. Then comes obviously warranty related expenses. And we talked about consumer durable companies, or let's say, electronic companies which sell products on warranty. Now, for them also, there is a possibility that some of the warranties are invoked, right? Which means the customer comes back and asks for some warranty related expenses. So if the company has sold a product, I think they should have a fair estimate in terms of how much will they be able to collect, or how much will have to pay in case there is a warranty related expense that comes over. Therefore, in such cases also, the firm should recognize expense in the period of sale and not when it actually occurs, right? So the customer may come back to you after 3 years, but if you think there's a 10% possibility of you paying these expenses, then recognize it upfront. And similarly, depreciation amortization, where you have a fixed asset, all costs associated those fixed assets. If it is a tangible asset, it is depreciation, and if it is an intangible asset, it is amortization, should be recognized in the year in which the asset is used, or in the same year in which you are using the asset. So per year allocation should be done. Now, besides expense recognition, there are certain other elements in an income statement. Now, these elements include non-recurring items. So while analyzing the financial statements from the purpose of forecasting them, it is imperative to remove the effect of one-off income or expenses. So if you have any one-time income or one-time expense as part of your profit and loss statement, one time means it doesn't happen every year. It is just an abnormal income or an abnormal expense. Very simple. You have a loss due to earthquake. Now, loss due to earthquake is a one-time expense. It is not going to happen every year. So you should eliminate such elements or such items in your analysis. These are non-recurring in nature. Now, these non-recurring can be called as unusual or infrequent items. This may include gain or loss from disposal of a business segment or assets, which means by selling a business segment or asset, gain or loss of investment in subsidiary, from sale of investment in subsidiary, provisions for environmental remediation. So if you are a company which is, let's say into mining, then there is a possibility that you will have to pay some expenses for environmental remediation or to ensure that the natural habitat is established back after the mining is done. Then impairments, write-offs, write-downs, restructuring, and integration expense for recently acquired business. All of these are typically expenses which are unusual or infrequent in nature. And in all of these cases, you should effectively remove them from your analysis. These are one-time items. In the same category comes discontinued operations. So these are discontinued, not discounted, right? Make that correction. This is a discontinued operation. It is not a discounted operation. What do we mean when we say discounted or discontinued operation? Discontinued operation means you have now shut down these operations, or you have actually sold these operations to someone else, right? So discontinued operation means you have decided to either sell, dispose of, but it has not been done so yet, or it was did in the current year after it generated a profit or loss. If you have anything called as a discontinued operation, performance should be reported net of taxes after net income from continuing operation. So you should show profit after tax, or let's say you should show operating income, and operating income should be based on continuing operations. And then there should be a line which says, the performance of this discontinued operation net of taxes. Any assets, operations, and financing activities must be physically and operationally distinct from the firm. Assets and liabilities should be reclassified as held for sale before disposal. Before you sell them, it should be classified as held for sale because you're trying to sell it. Now, how are these accounted in accounting terms? So if there are two things you are changing one, accounting policies, and second, you are changing accounting estimates. Two things, accounting policies and accounting estimates. If you're changing accounting policies, there is a retrospective application. What is a retrospective application? You have to adjust prior year data, which is shown in the financial statement, right? So all the prior year financial statements will have to be adjusted. But if you are changing a prospective, or if you're doing a prospective application, then you do not require to restate prior year data. So all the accounting estimates will have a prospective application. All accounting estimates have a prospective application, but all accounting policies, if you change, policies have a retrospective application, which means if you change an accounting policy, then you will have to change older data sets also, prior year data also. But if you change an accounting estimate, you only have to change in future, the data which is forward looking or future data. Then there is modified retrospective application where no prior period adjustments are required. Adjust beginning account values, which is basically for new revenue recognition rules. If rules change, then no prior statement adjustment required. Only forward looking or beginning account values have to be changed. But this is very clear that if accounting policies are changed, you will do retrospective. If accounting estimates are changed, you are going to do prospective. Prospective means only forward. Retrospective means backward will also be changed. In prior period errors, now if there are errors in prior period, then that is also retrospective. You will have to obviously change your prior financial statements because you have errors in your data. And if you're trying to rectify the errors, then obviously the older statements have to be rectified. They need to be fixed for all the errors which you have just encountered. So the prior period errors, if there are any, then they have to be requiring a restatement of prior period financial statements also. You should disclose the nature of the error and its effect on net income. And you can highlight why did the error happen, what was the weak internal control process which led to an error on the financial statement. So the summary is accounting policies and prior period items are retrospective, which means old data has to be changed. And estimates are only prospective, which means only new forward looking data has to be changed. Now this brings us to one of the most important topics in income statement where maximum questions are framed. And this is about EPS, earnings per share. EPS tells you how much profit a company earned per common share. So in short, when we say earnings per share, it is nothing but your profit after tax per share, adjusted for certain elements. It is one of the most widely used measures to check how profitable a company is for its shareholders. So the higher the EPS, better the business from a shareholder perspective. Now, from our perspective, when we say this, basic EPS shows the profit available only to common shareholders. It does not include the impact of things like convertible bonds, stock options, or other potential shares such as warrants or convertible preferred shares. Okay, so there are four types of securities: convertible bonds, options, warrants, and convertible preferred shares. And these, the impact of these four securities is not visible in basic EPS. Basic EPS only talks about common shareholders. So in basic EPS, you say net income, which is your profit after tax, minus preferred dividends, the dividends you pay to preferred shareholders, divided by weighted average common shares outstanding. Now, why are we subtracting preferred dividends? Because EPS is meant to show how much profit is left for common shareholders only, right? EPS only talks about common shareholder. So before we get to common shareholders, from net income, you will have to obviously pay preferred shareholders their dividend, right? So we'll subtract preferred dividends, and whatever is left over will be largely your money available for common shareholders. Also, preferred shareholders get paid first. They are paid money first. Then any dividend left over is available for common shareholders. So preferred dividends have to be subtracted before we calculate a basic EPS, which is payable or which is applicable to a common shareholder. So the basic EPS definition is very easy: net income minus preferred shares divided by weighted average common shares outstanding. Now let's do a quick calculation for the weighted average shares outstanding, the denominator. The numerator is relatively straightforward. Now look here, we have from January 1 to March 31, 1 or 100,000 shares outstanding, right? We have already said these are the number of shares outstanding for the company for the first 3 months of the year. Then on April 1, the company issues 20,000 more shares. So the total shares become 120. And then in July 1, the company also issues another 30,000 shares. Shares become 150. Now, we have to do a weighted average calculation. So the weighted average calculation says the number of shares, which is 1 lakh or 100,000, were outstanding for 3 months out of a total of 12 months. So the weighted average number is 25,000. Then 1,20,000 shares were outstanding for additional 3 months. They were between April to June. You had 1,20,000 shares. So in 3 months, you had 1,20,000 outstanding, which means the weighted average is 3 by 12, 30,000. But for the last 6 months, July 1 to December 31, 1,50,000 shares were there into 6 by 12, 75,000. So if you add 25, 30, and 75,000, your total weighted average shares are 1,30,000. This is necessary to calculate the EPS because if the company earned 260,000 net income and 130,000 is the weighted average shares, 2 is the per share value, 260 divided by 130. So we are straight away doing weighted average calculations. This into 3 plus this into 3 plus this into 6, the entire total divided by 12. And what you get is 130. Why are we taking 3? Because 1 lakh shares were 3 months, then 120 was additional 3 months, and 150 is 6 months. So it's a weighted average number for the entire 12-month time period. Now, diluted EPS equation includes all the 4 securities that we were talking about. The diluted EPS equation includes convertible debt. The diluted EPS includes convertible preferred shares. It includes warrants, and it also includes options, right? So there are 4 securities which are considered dilutive in nature. Now, diluted EPS shows what will be earnings per share if all dilutive securities were turned into common stock, giving a more conservative and realistic view of profitability. So we are trying to understand how much will be the diluted EPS in this case. Now, when we say how much will be the diluted EPS in this case, we have to obviously take into consideration additional shares which we will have to issue for all these dilutive securities. Now, what are these number of additional shares? See, if you have a convertible debt, then that convertible debt will get some shares and you will add the shares here. Then if you have some convertible preference shares, you will add their shares also in the denominator. Shares which are given to convertible preferred shares. And if you have some warrants and options, they will also be added to the denominator because these are the shares that you're going to issue to warrants and options. Perfect. Now, in this case, the denominator is very easy, but the numerator needs an adjustment. Now, in the numerator, what are we adjusting? In numerator, you will have to make adjustments for only 2 things. One, you have to adjust for preferred dividends, and second, you have to adjust for debt. Now, understand the adjustments here. When we say preferred dividends should be added back, why are we adding preferred dividends back? Earlier, you were a preferred shareholder. You were getting preferred dividends. But now, because you have decided that you don't want your preferred dividends and you want to convert your shares to common shares, so then you are not going to get preferred dividends and therefore we are adding them back. We are saying earlier I was paying you preferred dividends, but now you don't want to be a preferred shareholder, so I'm not going to pay the dividends to you, but I'm going to give you shares in the denominator. So for preferred, it's a simple treatment. Add the dividends back. For the debt, we basically add back the interest into 1 minus tax rate. This is the interest adjusted for tax savings. Because if you are a debt and if you want to convert to equity, you want to convert your shares to equity or your holding to equity, you don't want to be a debt holder, you want to get some shares. In that case, I don't have to pay interest to you. So I will add the interest back, but I will not add full interest. I will only add the interest which is adjusted for taxes, because my net interest outflow is interest into 1 minus tax rate. So in a diluted EPS, there are three additions to the denominator for different securities. And in the numerator, there are two adjustments. One, you add the dividends back, and second, you add interest into 1 minus tax rate back. So these securities give you a diluted EPS. Now, if the diluted EPS is less than basic EPS, then we call these securities dilutive securities, right? If these securities convert into common stock and if they reduce the EPS, then they are called as dilutive securities. But if these securities increase the EPS or leave it unchanged, which means if diluted EPS is greater than or equal to basic, then we call these securities anti-dilutive securities, which means they are not actually diluting it. After converting, they are actually resulting in an increase of your diluted EPS. So only if diluted EPS is less than basic, we call it dilutive securities. Else we call it anti-dilutive securities. So in exam, we are not sure what type of questions will be given to you, right? So in some questions you can find debt only, while in some other questions you may find debt and preferred shares. So you will have to adjust the equation for whatever is available. If there are only options, if there are only options available, then you don't need this, you don't need this, you don't need this, you don't need this, you don't need these four adjustments. If there's only options, you just have to add the options to the denominator. Warrants, you will have to just add the warrants to the denominator. So the equation will have to be modified based on what is available in the question. Let's take an example to understand this. Now, see, I have an example where it says net income 100,000, preferred dividend 10,000, weighted average shares 10,000. So basic EPS is very easy. Basic EPS will be 100,000 minus 10,090 divided by 10,000, right? Basic EPS will be straightforward. Net income minus preferred dividends divided by weighted average shares, right? So 9,000 is straight. But then we say there is a convertible bond. And if it is converted, it will be converted into 2,000 shares. And if it gets converted, interest on the bond after tax. So they've already given you after tax number, which is interest into 1 minus tax rate. They've already given you this number. So what are you going to do? You are going to adjust your numerator. In numerator, 1 lakh minus 10,000, this minus this, plus interest on bonds. You will add 5,000. That will be 95,000. And adjusted shares will be 10,000 plus 2,000 convertible shares, 12,000. So 95 by 12 is your diluted EPS 7.92. Now, because 7.92 is less than 9, this is a dilutive security. But if adding the extra shares increases EPS instead of decreasing it, then those securities are anti-dilutive and should be excluded from our calculation of diluted EPS. So in this question, there was only debt. Therefore, we just use half of the equation. We said net income minus preferred dividends plus only one part of the equation, interest into 1 minus tax, divided by weighted average common shares plus debt related shares. We have only used part equation. We have not used the full equation. So every time the question may throw a different set of numbers or data points for you. If there was a preferred shareholder, we would have made adjustments for preferred share also. Next, sorry. Next is vertical common size income statement. Now, what is vertical common size income statement? Divide everything by percentage of revenue. So if I have an income statement where I have revenue, cost of goods sold, gross profit. Let's say 1000 revenue, 200 cost of goods sold, 800 gross profit. Then the common size income statement means divide everything by revenue. And when you divide everything by revenue, this standardizes the income statement by eliminating the size of the firm, right? So we don't know then, is it a 100 rupee revenue company or $1,000 revenue company, right? Then you don't know what is the revenue, right? I can say cost of goods sold is 100, or rather, let's say the cost of goods sold is 50 and gross profit is also 50. So now by looking at these numbers, you can say one firm is small, the other is large. But by looking at percentage, you can simply say this company has 20% cost, this company has 50% cost. 80% profit, 50% profit. So there is no size impact. We are eliminating the effect of size. Such a vertical common size income statement where you divide everything by sales or revenue also does one additional thing for us. It helps us compare income statement items over time and across firms. So you can compare your own performance over the last 5 years, or you can compare the performance of the firm using a cross-sectional analysis. You can compare your performance with your competitor performance also. So that is also a possibility because ratio-based comparison is easy. Simple example, there are two companies, Northco and Southco, and both the companies have different revenue numbers. One is $75 million, the other is $3.5 million. So if you look at common size statement where we have divided every number by sales. So for Northco, we have divided every number by $75 million, right? All the numbers here are divided by $75 million. And all the numbers here are divided by $3.5 million to get you these ratios. So when we look at this, you can comment easily and say gross profit margin for North is 30%, but for South is 80%. Operating profit margin for North is 10%, for South is 45%. So no, your statements help you understand how is the performance, and common size income statement therefore definitely helps you to understand how is the performance and when would someone like to invest into a business or not. The exercise to create a vertical common size statement is relatively easy. All okay? Now, this also brings us to certain income statement related ratios. Very, very important from CFA level 1 perspective. Extremely important. Ratios are one of the most quizzed topics in level 1. Revenue growth, sales of this time period divided by sales of previous time period minus 1, right? You're doing a revenue growth, sales today, T divided by sales T minus 1 yesterday minus 1. And then there are four profitability ratios. These are profitability ratios. Each profit, gross profit, EBIT, EBITDA, net income divided by sales. So these are all profitability ratios, which means each line is a profit line. Gross profit is a type of profit, EBIT is a type of profit, EBITDA is a type of profit. These all lines divided by sales gives you what is called as profitability ratios or profitability margins. Gross profit margin, EBITDA margin, EBIT margin, and PAT margin or net profit margin. Then comes, and obviously profitability margins, higher the better. Higher these ratios are, better for you as a business. Then comes interest coverage ratio, EBIT upon interest expense. This means how much is the ability of a company to meet interest. So if there is a company which has interest of $50 in EBIT of $1,000, the EBIT leverage ratio or interest coverage ratio is 20 times. Versus another firm which has a revenue of 100 crore and is trying for an interest expense of 25 crore. That means we are looking at 4 times the ability to make more interest payments, after which they will start. Now, for us, obviously, interest coverage ratio is higher the better. The higher the ratio, the better the ratio. And interest coverage, and after interest coverage comes effective tax rate. That is the pre-tax rate, and or the effective tax rate would largely be tax expense, which is after the line which is called as profit before tax, right? So from profit before tax, we subtract tax expense and go to net profit. So if you divide this tax expense by is EBT or PBT, profit before tax or earnings before tax, what you're going to get is the effective tax rate. That is the tax rate that the company is paying or working with. So ratios are of extremely critical importance in, at least from an exam perspective, right? So be very, very clear in terms of your ratio based knowledge. Most of them, higher the better. Revenue growth higher, all profitability higher the better, interest coverage higher the better. The only thing is effective tax rate. You should have a lower tax rate and you would like to have a lower tax rate. Otherwise, all the ratios on the screen should be higher the better. Okay, all good? No questions? Surely then, let's move towards the next topic. This is something that we were pending from the last topic itself, and I said, yes, we won't be able to complete it in the time we had. So we wanted to do it today, but now we will move to the topic beyond the first initial topic. We'll try and cover a bit around balance sheet and cash flow from today's topic. But before that, we will do a, yep, we'll quickly start with the balance sheet topic now. So balance sheet and cash flow is what we are trying to focus upon. Let me just share my slides again. Okay, share screen. Okay, now let's talk about what is a balance sheet and how does a balance sheet look like? What does a balance sheet represent from a business standpoint or from a company's standpoint? From a company standpoint, a balance sheet is nothing but the reflection of company's assets and liabilities, right? So we need to understand what are these assets and what are these different types of liabilities. In a balance sheet, we typically find three components: assets, liabilities, and equity. Assets are all the resources which are expected to accrue economic benefit in future period. So an asset has the potential to give you future benefits. A liability on the other side is an obligation which is expected to accrue economic cost in future periods, or which you are expected to settle in the future periods. On the other hand, equity is the residual interest and is equal to assets minus liability, also known as net assets. So if you have to define them in one word, liabilities and equity are source of money, while assets are use of funds or use of money. Now in assets, there are a few different types of assets that we need to talk about. First, intangible assets. Intangible assets lack physical substance, which means they don't have any physical nature. These identifiable intangible assets can be separated from and controlled by the firm. So if it's an identifiable intangible asset, they can be sold off. These are also expected to provide probable future benefits, and carry cost can be reliably measured. These are assets which carry which have a value recorded based on future benefits. Example: patents, franchisees, licenses, trademark, customer list. All of these are examples of intangible assets and identifiable intangible assets, right? Which have a finite life and which can be separated from the firm. The only unidentifiable intangible asset, the only unidentifiable intangible asset which you cannot separate from the firm is goodwill. What do I mean when you say you cannot separate it from the firm? You cannot sell goodwill to someone, right? So, you can sell your patents, you can sell your franchisees, you can sell almost each asset on the balance sheet individually. But goodwill is one asset which you cannot sell individually. Goodwill is an asset that can be sold with the entire firm, or goodwill is an asset which you cannot sell at all, right? You will have to keep it with the firm. Now, how do intangible assets come to the balance sheet? Intangible assets can be purchased, and when they are purchased, they are recorded at cost. Which means, let's say if you have paid $1,000 to acquire a patent, that $1,000 will be recorded as the cost of the patent on your balance sheet. For a group of assets, price paid is allocated based on the fair value of each asset, right? So if you acquire a group of assets, let's say through a merger or an acquisition, then we do an exercise called as purchase price allocation. And in purchase price allocation, we typically allocate the value of all the assets one by one. We calculate the fair value of each asset, and that value is then recorded on the balance sheet. All these values which are recorded on the balance sheet are eventually amortized if they result in future benefits and have a defined life. Because these are intangible assets, they are expected to provide benefits in the future. And if there are benefits in the future, we believe these assets should be capitalized, then amortized over the life of the asset. Now, there is a possibility you have not purchased asset individually, but you have obtained all of them in business acquisition, which means you have acquired them. If you have acquired them, again, these are identifiable assets recorded at fair value. Difference between purchase price and fair value of identifiable net assets are reported as goodwill, right? So the idea is, if you have purchased a company, right? So let's say there is a purchase price. You have paid $10 million to acquire a company, and your fair value of assets minus fair value of liabilities is $8 million. The $2 million which you have paid additional is basically what is called as goodwill. So from purchase price, we subtract fair value of assets and liabilities. And this fair value of asset minus fair value of liability is also known as fair value of net assets. Right? Net asset means assets minus liabilities. What you get is goodwill of $2 million. Take an example. A motor vehicle manufacturer has research division that worked on the following project. Project 1, research aimed at finding a steering mechanism that does not operate like a conventional steering wheel, but reacts to the impulses from driver's finger. Project 2, the design of a prototype welding apparatus that is controlled electronically rather than mechanically. The apparatus has been determined to be technologically feasible, sellable, and feasible to produce. So, how do we create an intangible asset out of it? Now, we have been given summary of the expenses that the research division has spent. Material and service expense, labor, which is direct, and labor that is administrative, design, construction, and testing. So in general, the expense is 128 and 720. Project 1, 935, project 2, 620 on materials. Labor, different number, and design and construction, different number. So 5% of administrative personnel cost can be attributed to each project 1 and 2. And explain the accounting treatment of alpha's cost for project 1 and project 2 under IFRS and US GAAP. Because if you remember, the rules under IFRS and US GAAP are slightly different for research. When should you capitalize? When should you expense? So let's look at it. Now for project 1 under IFRS, everything is expensed, all the cost. For project 1 in US GAAP, also all expense. Now, why are we going to do that for project 1? So in project 1, we are saying that we are looking to make a steering wheel, right? And that steering mechanism does not operate like a conventional steering. So in this case, the project has still not achieved technological feasibility, right? And if you don't have technological feasibility, we are going to spend everything. We are going to just expense everything, right? We are not going to record anything as capitalized amount. But for project 2, we are going to capitalize all the expenses because the technological feasibility has been established. The technological feasibility has been established for project 2. So for project 2, because there is technological feasibility, everything gets capitalized under IFRS. But under US GAAP, it still gets expensed. So the English that we read in our last weekend class, where we discussed what can be capitalized and what can be expensed, is getting applied here. In certain cases, we are capitalizing it. In certain cases, we are expensing it. And the process of capitalization versus expensing is largely dependent on whether it's an IFRS or US GAAP mechanism and what are the rules related to it. So this is only getting capitalized because there is a technological feasibility that has been determined. In this case, there is no technological feasibility and therefore we have to spend all this money. But in project 2, we can capitalize all this money and then after capitalizing, we can amortize it. So this is nothing but the difference or the treatment variation between US GAAP and IFRS. Now, purchase price, as I said, the equation, what we already talked about, how to calculate goodwill, purchase price minus fair market value of identifiable net assets. And when they say net assets, it is asset minus liabilities. What you will get is a goodwill. This may relate to the payment for off-balance sheet items like reputation, key staff, customer relationship, strategic value, and may simply result from overpayment. So the idea is, why are you paying more? So if your company value was acquired at $10 million, and if your fair value is 8, then goodwill is 2. So the question could be, why is someone paying $2 million more than the fair value of the net assets? The reasons for the same could be, one, you want to keep this off balance sheet. You don't want to show to the world that you are acquiring it, right? In that case, you have a value which will be slightly on the lower side. Second possible reason why you are paying for a goodwill or why you have a goodwill is you overpaid. When the value of the business was only $8 million, you ended up paying $10 million, and the $2 million that you paid is more than the fair value of the business. Now, how does all this get recorded in financial statements? So investments not recorded at purchase price instead are goodwill, fair market value of net assets, which is included on a line by line basis with parent company, and equity, parent and the percentage post acquisition retained earnings of subsidiary, because these will keep changing over a period of time. So they are not recorded therefore at the purchase price. Now, goodwill is one asset which takes a lot more attention, because goodwill is a non-separable asset, which means you cannot sell goodwill and sell it separately. It is the only identified asset which has an infinite life, or which has no life associated with it. It's an indefinite life intangible, or indefinite lived intangible. So under accounting guidelines, goodwill cannot be amortized because goodwill has no life. Subject to annual impairment review. So goodwill is subjected to annual impairment. What do we mean when we say annual impairment? Goodwill can increase or decrease every year because of certain bad events with the business or some geopolitical concerns, etc. So which is called as impairment analysis. If the auditor believes that there were events which would have damaged the business reputation, then all those parameters should be captured in your goodwill. So we do a typical annual impairment analysis of goodwill. Impairment means loss of value for goodwill. Impairment suggests acquired operations are expected to generate lower future benefits than the price paid to acquire them. So impairment means therefore loss of value or loss of utility. So goodwill is not amortized, but goodwill is typically tested for impairment on an annual basis. Analyst adjustments remove goodwill from balance sheet assets when computing ratios, right? So balance goodwill should not be part of any ratios. Remove goodwill from impairment when examining operating performance, because impairment, as I said, is a one-time expense. So you should eliminate it while understanding or analyzing company performance. Now, financial instruments which are classified as held fair value. So securities under US GAAP which are held at fair value, their fair value is recorded through profit and loss. So if you classify a security as held at fair value, then such securities, if there's any profit or loss, is recognized in the profit and loss statement under IFRS. Available for sale securities under US GAAP, fair value through OCI, right? So if you remember OCI, we said other comprehensive income does not impact balance sheet. It does not impact profit and loss statement. They will largely look to prevent, or they will like to explain that in such cases, if there are available for sale securities, which are fair value through other comprehensive income, this will not impact my income statement, right? If it's straight away going to other comprehensive income, which means it is not impacting income statement. So there were only 4 items in OCI, right? When we did the first session, we said there are 4 elements in OCI. There is available for sale securities, there is pension related adjustments, there is derivative related adjustments, and there is translation adjustments. So only these 4 things are visible in your OCI bucket. Now derivatives, which are standalone or embedded in a non-derivative instrument, or assets with fair value exposures hedged by derivatives. These are all held at fair value. Then there are assets which are held at cost or amortized cost. These are unlisted instruments, because you don't know what will be the value of an unlisted instrument, right? That is generally not traded. So you hold it at cost. Example, if you have purchased the shares of a company, let's say NSE, and if NSE share price is 1500, this 1500 is going to remain in your portfolio as an unlisted instrument, because what you paid is the cost, and there is no other way to estimate the fair value at present, given the market is not trading NSE shares. Then there are held to maturity investments in US GAAP and amortized cost for IFRS. Examples, loans and receivables. These are instruments which are held to maturity investments. You give a loan and you hold it till maturity, and they are classified as held at cost or held at amortized cost. So if we are talking about financial instruments which belong to equity bucket, then this equity bucket can be classified into 2 things. Either you are going through trading profit and loss, or through the fair value through profit and loss. So if there are trading securities, they are going through profit and loss statements. Now, trading securities are held for trading purposes. Impact on balance sheet, held at fair value. Impact on income statement, dividends, realized gains and losses, unrealized gains and losses. Because you have held it for trading, you are allowed to record it into income statement. But if you are holding an asset which is non-trading purposes, in such a case, balance sheet will have an asset which is held at fair value. There will be unrealized gains and losses to report, and that is going to be done towards the end of this exercise. And then in income statement, there are dividends and realized gains and losses. So the security should be upfront clarified, and that should also help you record them appropriately in financial statements. FVOCI means fair value through other comprehensive income. Now, there could be financial instruments which are debt. if it's an IFRS framework, and if you hold it to collect collateral cash flows until maturity, or if you held to collect contractual cash flows but may be sold before maturity, in the first case, it is recorded at amortized cost, while in the second case of IFRS, you will record it through OCI, fair value through other comprehensive income. If it is held to maturity, balance sheet will be amortized. Then if it is fair value through OCI, like available for sale, then you are going to obviously record it on the balance sheet at fair value. The OCI is unrealized gains and losses. The income statement will show effective interest, and the income statement will also record recognized gains and losses here. But for US GAAP, if you have a security held for trading purposes or held for till maturity, fair value through trading account, fair value through OCI. In this balance sheet fair value, IS is effective interest and realized and unrealized gains and losses. So some of these guidelines have to be remembered from an exam perspective, because the exam may simply throw a number to you and just ask you to estimate where will be it recorded in what value, balance sheet, profit and loss, at cost, at fair value. So you will have to do that math as well as the decision in terms of where will this be stacked up. Now, under balance sheet also comes long-term financial liabilities. So on balance sheet, you create a liability equal to proceeds received less issuance cost. So for example, balance sheet carrying value is equal to amortized cost. So in subsequent period, you are going to just amortize all these liabilities also. Please remember, depreciation is not only associated with, liabilities. You are going to obviously record it. On the income statement, interest expense is equal to beginning liability into effective interest rate. And this is exactly where we say your interest rate does not match to bank's interest rate. Because when I look at the PDF, if I do the reverse calculations, the one way to do this, you can simply say PAT into 10% is your tax. The other way to say PAT into 30% or 30%, and we say PAT into 30%, this turns out to be 30%, but when you back calculate, it doesn't, because your effective interest rate could be very different, right? Your effective interest rate numbers could be really different to that extent. Sometimes taxes and interest rates therefore do not match when you multiply them by liabilities or you multiply things by profitability items, PBT, sorry. It doesn't match to the number that we are trying to work through, because there are some part inputs which are available with it. So your effective interest rate will be interest expense. And on cash flow statement for any of these long-term financial liabilities like bonds or leases, those are two largest liabilities that companies have. Bonds, or you can also call them debt, right? Loans. On cash flow statement, you are going to reduce your cash flow from operation by cash interest, right? That is the coupon that you have paid on the bond. Your cash flow from financing activity will be increased by the proceeds at issuance. Remember, you are getting the money. When you are selling a bond, you are getting money. So issuing a bond means proceeds at issuance. You will collect the money. So this is a cash flow from financing activity, and that will be increased by proceeds at issuance. And then cash flow from financing is also decreased by principal paid at maturity. At maturity, that will happen because at maturity, the cash has to go out of the business. It is a cash outflow. So on the financial statement, we should understand where to record all of these elements. If we cannot record them appropriately, then there is a possibility that we may not be looking at the right numbers. Now, how does this translate from an example perspective? Let's take an example to understand the same concept. Sorry. Illiquid Corporation issues a 3-year $1,000 par value 2% annual coupon bond for $918 with an annual yield of 5%. Using the effective interest rate method for annual periods. Look, you start with 918.3 because you have paid 918.3 and follow the table. It is a very easy table. Now, interest expense is 918.3 multiplied by 5%. That is your yield. Correct? So 918.3 multiplied by 5% is your interest expense number. Turns out to be 45.92. So your interest expense is nothing but 5% of opening balance sheet liability. When in year one, you have to pay a coupon of $20. Why $20? 2% annual coupon, $1,000 face value. So 2% of $1,000. $20 coupon is what you're going to pay. And therefore, there is an amortization. The amortization is basically the difference of the two. The amortization is 25.92. This means the bond value will be going up by 25.92 to 344. 344 is nothing but 918 plus 25.92. Now your liability value is 944. With a higher liability value, when you multiply 5%, the interest expense is also higher. And if interest expense is also higher, your amortization is also higher. Your amortization is the difference between the two numbers. The amortization is the difference between these two numbers, and the amortization is getting added to this number. So when both these numbers are added, you get 971. When 971 and 28 is added, you get 1000. So your liability starts at 918, but by the time the year 3 ends, you are at $1,000 and you pay $1,000 and redeem your liability, which means you reduce your liability by paying the $1,000. So this table is extremely important because this table is something that you're also going to use when you're going to do leases, because leases are also long-term liabilities. So leases and bonds work very similarly. They are cut, copy, paste. In this case, we had a bond which was issued at a discount. And therefore, the discount bond went from 918 to $1,000 at maturity. But then we have another bond which is issued at a premium. Correct? And when we were doing fixed income, we said if a bond is issued at a premium or if the bond is issued at a discount, by the time there is maturity, all of them will converge at the same point of $1,000. A premium bond will also converge at the same point of $1,000. So the premium bond issued at a price of 1053, 6% of 1053 is equal to this interest expense. And interest expense minus coupon is equal to amortization. And beginning liability minus amortization is equal to closing liability. And the cycle repeats. So this is a premium bond issued at a price above fair value or face value. In 3 years, the premium bond will become $1,000. And the prior one was a discount bond. In 3 years, the discount bond will also become a $1,000 bond or redeemed at $1,000. Which means in both the cases, we see a graph like this. Bond issued at a premium, bond issued at a discount will mature at face value. And this is also called as a concept of amortization. This is nothing but amortization schedules. These are amortizing your liability. Now, with balance sheet come balance sheet ratios. Like we had income statement ratios, and we said income statement ratios are absolutely critical from the point of examination. Balance sheet ratios are also extremely critical. And ratios form the fundamental of finance, right? A lot of times, if you cannot estimate the ratios correctly, you're struggling on financial topics. First one, current asset upon current liability. It is a current ratio. This ratio represents the near-term liquidity of a business. How is the business doing in the short term? Then the current ratio ideal is 2:1, which means any company that you look ideally should have two current assets for one current liability. Now, these ratios have not been updated since I was studying. The idea is at least remember the ratios and use them from the perspective of analysis of a business, right? More or less, these ratios should be used from the perspective of business analysis. Next, quick ratio. Quick ratio means only quick assets. You do not take all the assets. So in the numerator, you're only going to take cash plus marketable securities plus receivables and divided by current liabilities. Right? So you are only looking at assets which can be quickly converted to cash. And if that is the case, this ratio is giving you pure liquid coverage. How much liabilities are covered by purely liquid assets? When we say liquid assets, which can be quickly converted to cash or are equal to cash. This is useful for service or SaaS business with little inventory. Then there is net working capital by sales as a ratio. Net working capital by sales is telling you how much is your net working capital requirement, how much is the cash tied for operation. Then debt to equity ratio. Again, debt to equity, debt to EBITDA. Both of them are very similar. Debt to equity means debt divided by equity. Debt to EBITDA means simply debt adjusted for cash divided by EBITDA. Both these ratios, debt to equity and debt to EBITDA, debt to equity represents capital structure. How much money has been raised via debt in the company. Obviously, debt to equity is a ratio which should be lower the better, right? We would prefer a lower ratio for debt to equity for most of the businesses. Like we said, current ratio ideally is 2:1, quick ratio is 1:1, debt to equity ratio is lower the better. Debt to EBITDA ratio, once again, is lower the better, which means leverage and cash cushion, right? So if you have lower debt to EBITDA ratios, I think those are the better ratios. Very important ratio, ROA and ROE, especially return on equity, is extremely critical from level 1 perspective. Return on assets is, equal to net income upon, 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 average total assets. Now, ROA explains efficiency in using assets. How efficiently are you using assets in your organization? There is a possibility there are two people who are given a car to drive. And then end of the day, we are going to ask them who drove it more efficiently. So we will see whoever got more net income for the specific asset utilization is a better company largely. Return on equity, on the other hand, provides net income upon average equity equation. When we say net income upon average equity, we are trying to say how much return were generated by equity shareholders, right? So higher the ROE, better the company from an analysis standpoint, better the company from a shareholder perspective. So this return on equity ratio can be decomposed using DuPont analysis. And DuPont analysis is one of the most important analysis in the field of finance, specifically if we are trying to do ratio analysis. So when we say return on equity, it can be decomposed using DuPont analysis. How can we do that? ROE can be written like this: PAT upon average equity However, now this ROE can be decomposed or broken down. So PAT divided by sales, sales divided by total assets, and total assets divided by average equity. The first ratio is called net profit margin. The second ratio is called asset turnover, sales upon total asset. And the third ratio is leverage. So the return on equity can be decomposed into these three ratios. And the purpose of decomposing a return on equity into three ratios is to understand what is driving the return on equity number, higher or lower, right? By simply calculating return on equity, you will never understand why are the numbers higher or lower. But by decomposing them into smaller ratios, you'll be able to better understand why are the numbers higher or lower. So DuPont analysis allows us to do this decomposing part. Now, like we had a vertical common size income statement, we also have a vertical common size balance sheet. When we say vertical common size balance sheet, we divide everything by total assets. In vertical common size income statement, we were dividing everything by total revenue, total sales. But in this case, we are dividing everything by total assets. So all the lines, once again, all the lines will be divided by total assets. And once again, you can analyze the ratios and answer certain questions. You can say East is more leveraged, right? Or asset composition, West holds more cash, 10%, and relies more on plant and equipment, 77%. East has higher inventory. So you can just make assessment about the business by looking at the ratios. It's more of a relative concept. We're trying to compare our company against other companies in this sector. So the easiest way to do it is compare it across ratios. Questions? Anything that we discuss on the balance sheet? Specifically, I think as I said, return on equity is critical. Please ensure you know DuPont. If you do not know DuPont, it would be very, very difficult to solve for return on equity. The tables made here for amortizing any liability is again very important and critical from an exam perspective. Balance sheet ratios are critical. If you can understand with the concept between capitalizing and expensing, I think that should also help largely. Questions? Anything? Okay. Actually, good. Take the break. I think we'll keep it a shorter break today. We lost a bit of time at the start of the session, so we'll just keep a short 10-minute break. So take a 5-10 minute break, and I think we'll just get started with cash flow right after that break, right? So please take a very short break today. Apologies for that, but I think we'll just take a 10-minute break and be back with that break. So we'll pick it up at yeah, in another 10 minutes. Perfect. Okay, perfect. So we'll get started now with the cash flow statement, which is our third financial statement in the sequence of income statement, balance sheet, and cash flow. Again, has its own share of importance. It does help us identify the cash position of a business. An income statement, balance sheet may tell you a picture which may look good, but the cash flow statement is obviously going to tell you whether there is cash in the business or not. Are we struggling to generate cash as a business? Now, from a cash flow statement perspective, obviously, uh, why is it required? Now, cash flow statement, net income is more of an accrual concept, and accrual accounting does not tell us about the source and use of cash, right? Accrual accounting simply works on the concept of transactions, right? So when the revenue has been generated or expense has been incurred, we typically record it under accounting. It doesn't tell you whether the cash has come in or cash has not come in. A classical example, you may sell something to a customer, that's sales, that gets recorded on your income statement as sales, right? But the customer did not pay you any cash, right? Which is why the cash flow statement will tell you, yes, you did a sale, but the cash in hand is zero. And end of the day, cash is important. If you don't have cash, the business can come to a halt, or in certain cases, the business has to file for bankruptcy in extreme environments. So net income or net profit will not tell us do we have the source and the use of cash to meet liabilities and our operating needs, because you cannot delay expenses in certain cases, right? You have to take care of expenses, you have to take care of your liabilities. So if the customer has delayed payments, you still have to ensure that your operating expenses are met. Now, the cash flow statement has three components for us to work with under both IFRS, US GAAP accounting frameworks, and in general, under other accounting frameworks also. Cash provided or used by operating activities, cash provided or used by investing activities, and cash provided or used by financing activities. So there are three activities for us to look into, which is operating activity, investing activity, and financing activity. The total of all these three is your change in balance sheet cash. So we typically say your operating activity plus investing activity plus financing activity is going to give you net cash or net cash change. And this you will add to your opening cash to conclude what is your closing cash balance. Right. So you can say I'm starting my day with $10. Throughout the day, I earned $20 in operating. I've spent $5 in buying an asset, and I've spent another $8 in financing, which means I'm ending this 20 minus 13, $7. So in my opening, I should add $7, and I will end up at $17 of my closing cash balance, right? So $10 plus 7 and $17 is my closing cash. And this $7 cash balance is operating plus investing plus financing. Obviously, this is negative, which means you have used cash. Cash has been used in these two activities, and cash has been generated or provided by operating activities. So, in short, all cash flow statements behave in a very similar manner. There is operating plus investing plus financing. You get a net cash, and that net cash is then added to your opening cash to create what is called as closing cash for the business. Now, remember, net income is not equal to cash due to accrual processes, right? So, cash generated and spent in day-to-day core operations, you can compute, however, using net income can be used to compute what is your cash flow from operation. So, the way this works, one, if you have a cash book, if you have the cash book of the company, then you can simply use these equations: cash received from the customers, cash dividend received, cash interest received, payments you have made. You can just add, subtract all this. And by adding and subtracting all these, you are going to effectively get to the cash flow from operation. But for this, you need the cash book of the business. If you do not have the cash book of the business, then in that cases, you cannot use this equation. But you can compute this by adjusting income statement, removing non-cash charges, and adjust it for working capital. So if you want to calculate cash flow from operation, you can start with net income. Net income is nothing but profit after tax. And from this profit after tax, you will add non-cash expenses, and you are going to subtract working capital investments. So this is nothing but non-cash expenses called as depreciation and amortization. You will add back depreciation and amortization. Perfect. So that's in short, you can calculate a cash flow from operation. It is not necessary that you'll always need this. The idea is you should be able to calculate a cash flow from operation, because cash flow from operation tells you, is there enough cash available with the business? Now, in the next setup, you can also calculate cash flow from investing activities. And again, remember, there are different methods to calculate cash flows. So it's not necessary that there's only one method. There are two methods. There's a direct and an indirect method to do cash flow from operation calculation. And we are going to learn both the methods in a few minutes. But in short, yes, you can calculate a cash flow from operation using net income and certain adjustments like non-cash expenses added back, or working capital investment subtracted from it. Now, cash flow from investing activity means all the money spent on investments. Now, what does a company what does a company do in terms of investments? The company can buy plant property equipment. The company can generate proceeds from sale of assets. Like you can sell assets and generate proceeds. Investments in joint ventures. So you can invest money into your own joint ventures or affiliate associate companies. You can make payments for the businesses acquired. Again, you are acquiring something, you are investing into a business. Purchase and sale of intangibles, or purchase and sale of marketable securities. They're just examples, right? These are places where the company can invest money, or the company can withdraw money, right? By selling assets, the company can get some money. By buying assets, the company can spend some money. What is excluded? Trading securities. If you're buying securities from trading purposes, they are part of cash flow from operating activities. And cash equivalents, right? They are obviously part of the balance sheet cash. So you exclude these two elements while analyzing a cash flow from investing activity. Always remember, operating activity means money spent or generated by running company operations. Investing means money spent or generated by buying or selling assets. If you buy you have negative cash, right? The cash is going out. But if you sell, you have positive cash. The cash is coming inside the business. Then there is cash flow from financing activity. What do we mean when we say cash flow from financing activities? You have stocks, right? So you can sell stocks. There could be common stock issuance. So whenever a company issues common stock, that is the time company is selling shares. And when the company sells shares, it gets cash, right? They are receiving cash. Then there is treasury stock repurchases, which means you are buying shares. If you're buying shares, the cash is again spent. Then there are preferred stock issuance and redemptions. If a company is issuing preferred stock, or if a company is redeeming preferred stock, cash is coming in or cash is going out of the business. So anything to do with shares, loans, or dividends are part of your financing activity. So there's one very simple way to remember this. There's a one very simple way to map what will be part of investing, operating, and financing activity. Look at the balance sheet. A balance sheet has five components. A balance sheet has current asset, current liability, long-term assets, long-term liabilities, and equity. A balance sheet has these five components: current assets, current liabilities, long-term assets, long-term liabilities, and equity. Current asset and current liability are part of cash flow from operation. The only thing is, except short-term loans. Short-term loans are not part of operation. Long-term assets are part of cash flow from investing activity. And both of these, long-term liabilities, equity, plus short-term loans, are part of cash flow from financing activity. So everything written on the balance sheet in current asset and current liability are part of your operating cash flow, except short-term loans. Everything written as part of long-term assets is part of your cash flow from investing activity. And everything written in long-term liabilities or equity side of the balance sheet, including the short-term loans, is part of the financing side of the balance sheet or cash flow from financing activity. Now, how do we classify certain elements under IFRS and US GAAP? And as I said, important list of items, right, which you would like to remember. Interest received. Again, under US GAAP and IFRS, there is an option available. In US GAAP, it's a cash flow from operating activity. In IFRS, you can put it under operations or investing. Interest paid under operating or financing, right? So you will have to try and remember these elements because in exam, there will be straightforward largely. IFRS gives you a bit of flexibility. US GAAP does not give you a lot of flexibility. It is either part of operating or financing, only one side. But in IFRS, you have some flexibility to include it into operations or investing or financing. In US GAAP, you have to provide a reconciliation between net income and cash flow from operating activity. Format is the same for both of them, direct or indirect. Bank overdraft, the only thing is part of balance sheet cash, right? And that is exactly the way the differences are stacked up. So this is a table which you would like to remember. And just I think one easy way to remember is IFRS offers some flexibility in terms of where will you classify this. Like for example, taxes. Now, why does IFRS say this? So IFRS thought process is taxes paid. IFRS says if you are paying taxes related to the business operations, put it in operating cash flow. If you are paying taxes related to investments, which means let's say capital gain tax, put it in investing. And if you are paying taxes related to any financing activity, then put it under the financing bucket. So IFRS is a bit flexible and says, okay, take the nature of the tax, and based on the nature of the tax, classify it in either of the three buckets. Classification summary, like in operating activities, where will the money come from? If you collect cash from customers, money will come. If interest and dividends are received, money will come. If you sell proceeds from trading securities, money is going to come to you, inflow. Where is the outflow? Cash paid to employees and suppliers, it's an outflow. Cash paid for other expenses, again, it's an outflow. So acquisition of trading securities is an outflow. Interest paid on debt or leases, taxes paid, everything is an outflow. In these cases, the money is going out of your pocket. Under investing activity, if you're seeing inflows, selling of any type of asset, whether that is plant, property, equipment, intangibles, all of that is inflow. But outflows, acquisition of plant, property, and equipment, acquisition of debt, or loans made to others, all of them will be an outflow. The money is going to go out of the business. Next, under financing activity, inflows, principal amounts of debt issued, then again proceeds from issuing stock, all of them will result in inflow. The cash is going to come to the business because if you're selling shares, cash is coming. Outflows, if you pay debt, also if you raise debt, right? If you borrow debt, then again in that case, the money is going to come. Perfect. So every time, and again, remember, this is just an indicative list. This is just an indicative list. This is a list detailing what are the inflows and outflows. But I think the easiest way to remember at times is try and always understand what covers these three cash flows. As I said, operating activity will have all current asset, current liability related inputs. This will have all long-term assets, and this will have all long-term liabilities or equity, right? Along with obviously short-term loans. Now, non-cash charges and gains. So whenever we say non-cash charges and gains, these are depreciation and amortization. These are impairments, gains and losses on asset disposals. Again, changes in deferred tax asset and deferred tax liabilities. All these items eventually are part of non-cash expenses. These are something which we are saying these are the non-cash type of expenses or non-cash related events. Some of these are obviously part of your cash flow calculations, and we have to treat them by adding them back or removing them from the requisite bucket, right? So for example, if we have gain from sale, then that gain from sale of asset is part of investing activity or operating activity depending on the framework. So you will have to make that adjustment in the cash flow. Now remember, from a level 1 perspective, a level 1 examination will not ask you to prepare the entire cash flow, because as I've earlier said, a level 1 exam does not focus on making accountants. But what you can get is interpretation, right? What you can get is an interpretation of any accounting statement, and elements from it in terms of what are the numbers or what are the line items trying to tell you. So that is something that is expected from you, that you are able to interpret and answer in terms of these elements largely, that what element falls under a specific category. Now talking about cash flow from operation calculation, and I think this is where you will have a lot of questions coming your way. Direct method and indirect method. How do you calculate a cash flow using direct method and indirect method? Most of the companies use indirect method. In real life, most of the companies practically use indirect method to do calculations for cash flow statement. You begin with net income, which is net profit, and make necessary adjustments to get operating cash flow. In direct method, you just identify actual cash inflow and outflow, right? So if you're going to do a direct method, you will need cash book. But if you're going to do a indirect method, you can do it using a profit and loss balance sheet, right? Your profit and loss and balance sheet statement can help you do a indirect method calculation. Now, why do most of the companies use indirect method? Under accounting guidelines, if a company uses the direct method, they will have to present indirect method also, right? So if you're going to use a direct method, most of the accounting frameworks say you also have to provide an indirect method for the user mandatorily. And therefore, most of the people straight away use indirect method because they have to anyways prepare it. Whichever method you use, the value of the cash flow from operation will be the same under direct or indirect method. But this is the only a method used for operational cash flow, CFO. This method, there is no difference in the methods, or there are no two methods for investing and financing. The method is only for cash flow from operation. They are unaffected from this. The two other cash flows are unaffected. Let's look at direct method. When we say direct method, working down the income statement, take each income statement item in turn. For example, cash receipt from customers, cash paid to vendors, right? So if you're doing a direct method, you walk down the income statement, then move to the balance sheet and identify asset and liability accounts that relate to that income statement item. Example, sales in income statement is related to account receivable in balance sheet. Then cost of goods sold is related to inventory in balance sheet. So you will have to relate the items and then find an equation. Calculate the change in balance sheet item during the period, which is ending minus opening. And then you will be able to create the equation for direct method. For example, sales $10,000. Account receivable last year, or let's say the prior year account receivable and the current year account receivable. Account receivable moved from 500 to 1500, which means the change in account receivable is equal to 1500 minus 500 or 1000. Now, this is an increase in asset. Your asset has increased by 1000. So you deduct it from your this line. You're going to say sales 10,000 minus change in account receivable 1000, and what you will get is 9,000 rupees, which is equal to the cash received. So you have established a relationship between sales or revenue and account receivable. And by establishing this relationship, you have estimated the cash. So this way, there are many relationships or equations linked to each other. This could also be linked to payables. For example, you can say purchase expense. Purchase expense 5,000. Okay. And then you are saying accounts payable. Accounts payable were 1,000 and now the account payable are 0. Prior year, current year, which means how much cash was paid to vendors. It will be purchase expense 5,000. But because there is a decrease in liability, the liability decreased, right? You are going to simply say in the current year, right? My liability has gone from 1,000 to 0, which means I'm going to simply subtract this 1,000 from here. Cash paid this quarter, this year is 4,000 and 1,000 from the previous number. If your liabilities go up to 2,000, you are going to say my cash paid has gone up from that perspective, right? So this is an equation that we would like to design for most of the methods. The steps till you get to the rule, and then after getting to the rule, you create an equation, right? Adjust the income statement amount by the change in balance sheet as we were doing, like we said, sales minus increase in account receivable, right? We created an equation. And then you repeat the same step for each item on the income statement. You keep going on the income statement step by step and you keep creating equations. There are a lot of equations, therefore it is difficult to memorize the equations. You will have to obviously calculate all these equations. You'll have to prepare all these equations, right? And that equation can help you do direct method used for cash flow from operation. Now the cash book or the bank book statement can become the direct source of information. If you don't want to do all this equation calculations, you can straight away take the cash book or the bank statement, and from that you can estimate your cash flow from operation numbers. All these numbers will be available in your cash book, and you can add, subtract, and get to the cash flow from operation number. The benefit, it's easy to understand. A lot of people will be able to easily comprehend cash accounting. How much money come in, how much money is going out, and it's convenient for some of them to work with this number. Non-cash items like depreciation are not considered. So in your cash book, you won't have anything like a depreciation to be considered. And non-operating items like sale of assets, etc., are not considered again because they are not operating related activity, right? They will be reclassified in other cash flows. Now, for direct method, like we have a data here, try working out a cash flow from operation. The company has an income statement provided to you. Interest will be treated as a CFO and dividends will be paid as a CFF. Balance sheet data is also given to you. Try doing a direct method cash flow from operation. Take 5-7 minutes. Try and look at the data. Post which we'll solve this. Step 1, calculate how much is the cash collected from customers. So try and calculate cash collected from customers. That is your first task. And cash paid to suppliers. Those two things, I think you will have to first adjust. This is your balance sheet and this is your income statement. So if you want to take a snapshot of the income statement, so for the first one, which you're trying to estimate, you will obviously need, if you're trying to find cash from customers, you will need revenues, right? So I will write revenue here for you. Sorry. Revenue is 225,000. Okay, that is one number that you will need. So let's keep revenue number here for you. For suppliers, you will need cost of goods sold. So I will write the number here 124,000. Everything else is on the screen for you in terms of balance sheet numbers. Come on, cash from customers. Okay, think about this. Customers are related to revenue. Customers on the balance sheet are related to receivables. And customers are also related to what is called as unearned revenue. So you have to link these three things: revenue, receivable, and unearned revenue to understand how much cash is collected from customers. Obviously, we will need change between the two numbers, right? So we are saying that my unearned revenue have increased by 30,000 and my receivables have also increased by 5,000. This is a liability. This is an asset. If asset increases, we subtract. If liabilities increase, we add. So your cash collected from customers will be revenue 225,000 minus receivables change plus unearned revenue change. And this will be 225 minus 5 is 220 plus 32, 50,000. That is the amount of cash you have collected from your customers. Revenue minus increase in receivables plus increase in liabilities. All increase in assets are subtracted. Okay, so that is your first element. That is the cash collected from customers. Now cash paid to suppliers. Now suppliers are related to cost of goods sold, payables, and inventory, right? Because you are purchasing, so you should also know how much is the inventory. So you are telling me that we have sold 124,000. You have sold products worth 124,000. But when you sold 124,000, my inventory also reduced, which means you sold 4,000 old inventory. This means you purchased 120,000. Your purchase was 120,000. You purchased inventory worth 120,000, but you sold worth 124,000, which means additional 4,000 was sold. From this 120,000, your payables have gone up of 18,000. So in this, you will add liability again. This is obviously expense, right? This way. You had a minus 124,000 of expense. From minus 124,000 of expense, 4,000 added back. Minus 120 plus 18 minus 102 is the cash you have paid to your suppliers. So your first set of math works like this. Net revenue minus increase in receivables plus increase in liability, cash collected from customers. Cost of goods sold plus inventory, purchases, account payable related changes, and cash paid to suppliers. So you will have to establish these linkages between income statement and balance sheet. Now we can do the same thing for operating expense. Your operating expenses were 25,000, but your other liabilities increased by 8,000, which means you have to pay 25,000, but you did not pay 8,000. Your net cash outflow was only 17,000. Increase in liability means you have not paid the money. Now, same thing for interest expense. Depreciation, obviously, we won't charge, it is non-cash. Now, for interest expense, very similar, $3,000 of interest expense. However, your interest payable on the balance sheet increased by 2,000. And that means the cash interest paid is only 1,000. Look at this. Interest payable has gone up by 2,000. Which means earlier you had to pay 6,000, now you have to pay 8,000 of interest. And if you have to pay a higher interest of 8,000, which means 2,000 more, you have paid 2,000 less this year. So the net cash paid is only $1,000. For tax provision, very similar. And finally, you are going to add all the cash numbers that we have calculated. 250 minus 102 minus 17,000 minus 1, 18,000 minus 32,000 is equal to cash flow from operation 98,000. All good. So direct method will require estimation of equations or a cash book. And from that, you can create a cash flow from operation. Now, indirect method is more easy and more intuitive. It starts with net income, and then working down the balance sheet, you adjust the net income for different balance sheet items. There are only two rules to remember. The slide says four rules, but I think you can summarize the two rules. The two rules are increase in asset is a reduction in liability or reduction in cash actually. An increase in liability is basically cash positive. If your liabilities are increasing, the cash is going to increase in the business because you're not paying it. You're just delaying the payments for certain vendors, etc. But if your assets are increasing, your cash is going down because every time you buy an asset, you spend cash. All okay? So that is what the framework is all about. Start with net income. Then to that net income, add non-cash expenses, and to that non-cash expenses, add or subtract increase in assets. Now, in this case, indirect method for the first one, and the answer is the same, right? You start with net income, and that in an indirect method, you take a change of all elements on the balance sheet, which are current assets and current liabilities. Okay. So creating these working capital items are the most confusing for a lot of people. And I think the easiest way to remember them is two rules, as I said, increase in any asset is decrease in cash. That is rule number one. And increase in any liability is increase in cash. You just have to remember these two. If asset is increasing, cash is going down. If liability is increasing, cash is going up. Liability asset position 4,000 depends, is the inventory increasing or decreasing? Accordingly, minus or plus, right? So for this 108, we will have to just, when we say this delta, I think the better way to write delta is increase. Is the number increasing or decreasing is what we should always look at. So inventory in our case, for example, was reducing, right? So if your asset is reducing, which means cash is going up. This means if the asset is reducing, cash is going up. Because if the asset reduces, which means you have sold the asset. And if you have sold the asset, the cash goes up. So this is cash going up. Increase in payables, liabilities, and the number should largely match the number from this operation, right? So in these two cases, we have to figure out there is a possibility there is a mistake somewhere. Oh, this is the one which we've done here from this, and we've adjusted for elements additional, which are non-cash items to get to the 98,000 number that we have here. Okay, in the one, we had only one non-cash item, which is depreciation. And then we have adjusted for other non-cash items here. So your cash flow from operation cannot change depending on the method. You can take any method you want. Your cash flow from operation should still remain the same. Now this entire exercise can be sorted or finished in a very small equation also. Remember, we said you can calculate cash flow from operation using net income, non-cash charges, and working capital investment. We already know the net income is 37,000. That is profit after tax. Non-cash charges, 14,000 depreciation, 18,000 gain on asset disposal, 6,000, 10,000 for tax liability. So net, we are looking at 6,000 and all current assets and all current liabilities, excluding cash and excluding short-term debt. The change in working capital is 55,000. Goes here, and 98,000 is the number. So in short, you can conclude the cash flow from operation if you have the working capital investment. Now remember, this is working capital investment, which means how much increase in working capital. This is increase, which is why we are subtracting. If working capital increases, cash goes down. So we are subtracting increase in working capital. But if you look at it, your working capital from 12,000 has gone to 67,000 negative, which means your working capital has actually decreased. So minus 55,000 with a minus sign actually increases your cash flow. Okay, this is why that 55,000 is getting added. Now from investing activities, again, there are no two different cash flows. So investing activities is all about making it on the same cash flow. So cash flow from investing activity consists of cash inflows and cash outflows that result from acquiring or disposing of long-term assets. So when we say it depends on acquiring or disposing of long-term assets, buying or selling the long-term assets, in such a case, cash flow from investing activity proceeds from disposal minus cash paid for additions. If you buy an asset, you are paying to add the asset. But if you are selling, that proceed is coming to you. So cash flow from investing is all about assets purchased or assets sold in long term. Example, now we have some data for the same company which we did, and we need to understand what is the cash flow from investing activity. First, look at what is your gross block doing. So your gross block is telling you that last year you had 282,000 of assets. This year you have 309,000 of assets, and you have purchased 45,000, right? So the ideal number should have been 282 plus 45, 309. But the problem is you also have cost of disposed asset. You have also sold assets. That sold asset number should come here to get you this math running. So you're going to say 282 plus 45, right? Minus something. That should lead me to 309. So you can calculate the plug-in number here. The plug number can either be calculated or the plug number can be taken from the data that we have in the past, right? So this is something 282 plus 45 is 7, 287, 287 and 40. 97, 307, 317, 327, right? So the number collectively, sorry, the number collectively should have been 327,000. However, the number is 309, which means 18,000 should be the asset that you have sold. And this can also be seen here. gain on asset disposal. You have sold asset worth, or you have gained worth 18,000 on sale of asset. So first number is this. We have figured out what is the cost of equipment sold using this data. Then how much is the depreciation? Last year was 80. This year is 88. Closing, accumulated depreciation closing. So we should know what is the depreciation in between these two numbers. How much depreciation do I need to factor in? So you're going to say my depreciation expense, okay, and then minus depreciation related to the asset that I sold. So my depreciation expense is 14,000. So I'm going to add 14,000 here. 80,000 plus 14,000, but I'm only ending with 88,000, which means 6,000 was the depreciation associated to this asset that was sold, which I got no benefit of. So I calculated my depreciation also. Accumulated depreciation 80 plus depreciation expense for the year 14 minus accumulated depreciation of the disposal entity or of the disposal asset. And now your cash flow from investing activity. You're going to say 30,000 was raised by selling. So that is the money that I got. 45,000 is what I had to spend to buy assets. This is 45,000, and therefore 15,000 is my negative cash flow from investing activity. I've lost 15,000 additional because I've spent more than what I achieved. For financing activities, we always say it's about a firm's capital structure. So what are you transacting with, which is affecting a firm's capital structure in terms of debt and equity? So all borrowing related cost, all equity related cost is all financing activity. Cash flow from financing therefore means cash dividends paid plus equity issued plus debt raised. So for the same company, this is what the retained earnings look like. And then from that, you're also looking at what is the dividend paid. So if the company is paying $7,000 of dividend that is going out of the company, minus $20,000, that $20,000 is effectively telling you the amount of equity repurchase or loans that have been repaid plus 10,000, which is again debt raised or debt repaid, right? So if we look at our question, balance sheet, look at this, bonds issued. So 10,000 is coming in the company. You have issued the bonds. And stocks have reduced from 1 lakh to 80,000, which means 20,000 is going out of the company. You have purchased some shares. So which is why we are saying 20,000 is going out of the company, share purchase. And 10,000 is coming into the company by way of debt. So money inflow, money outflow, minus sign. Net cash flow from financing activities minus 17,000. The solution, operating cash flow plus investing cash flow plus financing cash flow is 66. This plus this plus this. And from this, if we add 18, we get 84,000, which is the cash for the year ended 2022, right? And let's look at the balance sheet. How much cash do we have it there? 84,000, right? So that is the cash that is getting recorded on the balance sheet worth 84,000. So this is how a complete cash flow looks like, or a cash flow can be worked through. Now, what is the analysis part of this cash flow? From an analysis standpoint, we are saying we are trying to understand where are the major usage of the cash, right? Where is the cash getting consumed and where is the cash getting generated by the company? That is our primary objective of analyzing the cash flows. Now, when we analyze the cash flows, CFO is important. See, cash flow from operation is the most important cash flow that we are looking at. What are the major determinants of cash flow from operation? Is operational cash flow higher or lower than net income? And how consistent is cash flow? You would want your company's cash flow statement to be very, very consistent, which means operationally the company should keep generating money. Then CFI, why or what is the cash being spent on? You need to understand what is a related asset, what is a non-related asset. I think the better word is operating versus non-operating asset. Third, is the company investing in PPE? That would be visible if the company is planning capital expenditure. And if the company is trying to build a capital expenditure, then all that capital expenditure is going to translate into plant, property, and equipment. Are there any acquisitions made by the company? Because if there are acquisitions made, again, company is going to spend money. And if the money is going to go out of the company, then you should be aware about where the money has been deployed. Next, analyze cash flow from financing activities. How is the company financing, investing, and operating cash flows? Are they selling loans or are they raising through any other external source of financing? Now, in operating or in financing cash flows, you also have to understand, once we know how is the company financing this, right? Whether through investing or operating cash flow, try and understand if you're a loss-making business, your operational cash flows are negative. You're not getting any money via operations. So then if you don't have any money via operations because you're a loss-making business, the only possible option is investing or financing. You can sell your assets, generate cash, and fund the business. But if you're a startup who has a loss-making business, you don't have a lot of assets to sell. In such cases, you may look at large investors, and those investors may provide financing cash flows. And that financing cash flow can then be used to bridge the gap created by operating cash flow. Is the company raising or repaying capital? And what dividends are being returned to the owners? Right. So these are the decisions which we should look when we are trying to analyze the cash flow from financing activity. Like income statement, balance sheet, there is also a common size cash flow statement. Now, in common size cash flow statement, there are two possible options. In income statement, you had no option. You have to divide everything by revenue. In balance sheet, you had no option. You have to divide everything by total assets. In common size, you can express each item as a percentage of the total cash flow, inflows or outflows, right? That is option number one. You can represent everything as a percentage of total cash flow. Option number two, percentage of specific activity, which means each item is expressed as a percentage of its respective activity. which means total of operating, investing, or financing activity. Why would you like to do this? It makes it easier to compare companies again of different sizes, and it helps track how much cash goes to operations, investing, and financing. So you can look at this optically and decide, okay, we are spending a lot on, let's say, investing activity, and maybe we need to reduce investing activity and pay more of our liabilities. Now, cash flow statements also have ratios. Like all other topics, cash flow statement also have ratios, but less important. I think more important ratios were income statement, balance sheet. But cash flow statement also has certain ratios, like operating cash flow ratio, which is cash flow from and on most of these ratios will have CFO. Most of these ratios will have cash flow from operation in the equation, because that is the most important cash flow that we are trying to read. So these cash flows ratios indicate different concepts. Like first one, cash flow from operation divided by current liabilities helps us understand what is the cash in short term versus the obligations, cash strength versus short term obligations. Free cash flow yield better return to generator. Higher the free cash, the more the company is going to generate returns for the shareholders. So people try and do this as a ratio and calculate free cash flow divided by market cap. Cash flow margin, nothing but like other margins were calculated, EBIT by sales, EBITDA by sales, similarly CFO by sales. Then capex coverage ratio. Again, the way capex coverage ratio is calculated is cash flow from operation divided by capex. Now, the capex ratio or all other assumption ratios are largely based on, let's say, competitor data or on your own data. This is trying to tell you how much can they generate in terms of cash to fund their capex requirements. Then cash conversion cycle. You've read this, inventory plus receivable minus payables, right? So I think the equation is receivable plus inventory minus payables. And then comes cash interest coverage. So cash flow from operation plus interest paid divided by interest paid. Higher the better. The more you have your cash interest coverage ratio, the more debt the company can take, the more loans the company can take and provide interest on those debts. Again, this should be higher, this should be lower. Cash flow margin, obviously higher the better, growth higher the better. Capex to coverage ratio is something which is not available for now, because we can't make a lot of commentary around what their numbers are and how they're looking at. So maybe we can talk to the management and see, are they expecting a massive demand? If they're expecting a lot of demand for products or services, then they may want to spend a lot more on capex. And that is where your CFO to capex ratio may become fairly interesting to look at. Now, barring this, there are two types of valuation cash flows. These are valuation cash flows. Please remember, they are used to value firm. These are not accounting cash flows. Always remember, these are not accounting cash flows. They are used to value firm. And the two ratios are FCFF and FCFE. Free cash flow to firm and free cash flow to equity. So if you're looking at free cash flow to firm and free cash flow to equity, FCFF and FCFE, you can calculate them based on all the inputs that we have read through net income, non-cash charges, minus working capital investment, which means increase in working capital, plus or rather minus again fixed capital investment. Now they are doing an adjustment here because they are starting with net income. We started with EBIT. right? So we had to not pay any tax, which is for us the equation was net income plus non-cash charges minus working capital investments and minus fixed capital, right? Because they are starting with net income, they are making an additional adjustment here. If we start with EBIT, we generally make no such adjustment. With EBIT, we simply day one minus tax rate plus depreciation amortization minus working capital investments minus fixed capital investment, which is capex. So the equation changes based on where you start your equation from. If you're starting from net income, it's a bit different. If you're starting from cash flow from operation, it's a bit different, right? These three terms collectively were nothing but cash flow from operation. So you can replace it like this also. Remember, these are valuation cash flows. Higher are these cash flows, better is the value of the company. Simple examples, if you look at the last example itself and plug that numbers in, you will get to the number of FCFF and FCFE, free cash flow to firm and free cash flow to equity for the same company. Perfect. So I think that is all that we have for today's session. The session has a lot of